Long gone are the days where ETFs are synonymous with broad market passive strategies. The SEC ETF rule in 2019 widened ETFs' operational flexibility and made the ETF a practical wrapper for a vast array of strategies. Active bond ETFs have been a notable beneficiary of these developments. Investors can now easily access active fixed income managers while enjoying ETFs' trading convenience and transparency. This new crop of bond ETFs also tend to bear a lower fee than mutual funds, making them formidable competition for traditional bond strategies. If you're looking for a new addition to your fixed income sleeve, here are 3 promising bond ETFs that do more than your typical index fixed income fund. First up is gold-rated iShares Total Return Active ETF, ticker BRTR. When you might know them for their passive ETF empire, iShares is making steady inroads into the active domain. BRTR leveraged BlackRock Active Fixed Income Organization, one of the strongest in the industry, as well as their expansive swath of supporting functions. Industry veteran Rick Reeder leads up the fixed income group here and oversees this fund alongside lead manager Ji Chen. This team has seen some reshuffling in recent years, but has no shortage of experience, as all named PMs are long-standing members of the fixed income organization at BlackRock. The managers make top-down sector allocation and interest rate calls, as well as determine the fund risk budget. They leverage BlackRock research capabilities to identify major market trends and utilize BlackRock Aladdin to timely and precisely manage portfolio risk. The ETF taps into BlackRock's well-resourced teams of sector specialists for fundamental research and security selection at the sector level, ensuring both breadth and depth of market expertise. This portfolio flexible mandate served it well this year. BRTR outpaces category average and category index by 45 and 49 basis points between January and August 2025, respectively. The mutual fund sibling longer track record has been solid since lead manager Rick Reeder took over in 2010 as well, beating both benchmarks on an absolute and risk-adjusted basis. Next up, Dimensional Core Fixed Income ETF DFCF, which attempts to outperform the market by systematically positioning its duration and credit risk profile. Bond prices do most of the heavy lifting in these strategies. The manager used current price to calculate an expected return for each eligible bond. They pursue those with the best return potential within a set of constraints, which will shape the fund's duration and geographical positioning. This strategy generally tilts towards shorter-term bonds when the yield curve is flat or inverted. The fund also takes a systematic approach to credit risk. The manager adjusts bond credit ratings to reflect market opinions using price, market yields, and credit default swaps. They stick to investment-grade bonds but steer the fund towards lower-rated bonds when credit spread widen and higher-rated bonds when credit spread tighten. Compressed credit spreads throughout 2024 kept this allocation to BBB-rated bond above that of the category index. The fund outperformed the index by 71 basis points between January and November of 2024. Constraints keep the fund composition close to the Bloomberg US Aggregate Bond Index, including duration, industry, and issuer level thresholds. The ETF also employs a flexible trading philosophy, which adds to its edge. Traders choose bonds with the lowest rating cost from a basket of eligible bonds with similar characteristics. These features, combined with an affordable 17 basis point annual fee, help DFCF outpace its category index and category average between its November 2021 inception and August 2025. Its risk-adjusted returns were better than both benchmarks over this period. And last but not least, bronze-rated DoubleLine Opportunistic Core Bond ETF, ticker DBND. This ETF is a core plus bond offering from veteran duo Jeffrey Gundlach and Jeffrey Sherman. Both lead managers have decades of industry experience and leverage strong teams of sector specialists who are deeply involved in the ETF's daily activities. And sector expertise is where this portfolio shines. The ETF process starts with DoubleLine monthly asset allocation committee, where the firm decide high-level guidelines around sector allocation, duration, and risk. Teams of sector portfolio manager then contribute bottom-up security research and select their best sector picks to build out the portfolio. This ETF often favors securitized and emerging market debts, strong areas of expertise for the sector managers. Unlike many peers that focus on opportunities and corporate debts, DBND nearly 50% stake in securitized bonds hold the largest sway over its return and is an overweight compared to the category average. While the managers might take on more sector bets, the ETF duration tends to hawk that of the average peer and the broader bond market. This process has led into strong results so far. The ETF outpaced the category index by 57 basis points annually between its March 2022 inception and August 2025, with lower volatility. 2022 was a bright spot thanks to the fund's shorter duration, and the ETF's good credit risk selection also paid off in 2024.